Okay, welcome to episode 7 for savvy business owners who want to work less, earn more, and have considerable wealth. Today is something relating to asset classes. Okay, so you'll know from episode 2 of our podcast that I spoke about passive income and why that's important. And one of the things that I get back quite a lot is, what should I invest in? What should I buy? And most people just think around shares and property. And at the moment, property, especially in Queensland, is going a bit crazy. So everybody is jumping into property. And that's not necessarily a bad thing. But what I wanted to discuss in this particular podcast is, look, it's not just property and shares, although that's going to be a big chunk of whatever you probably decide to do. Okay. So when I'm talking about creating passive income, what I'm saying is we need a certain asset classes, certain investments that are going to generate passive income. Either that passive income is going to come now or it's going to come later. Okay. But you need some kind of investment in order for that to happen. Okay, so today's podcast is, what are the investments? What are the asset classes you can put money into in order to generate either passive income and or long-term wealth? Okay, so the first one is the obvious one. You keep all your assets in cash. Okay, not a really good strategy. It's pretty useless, to be quite honest. And the reason is historically, cash has always been considered a bad investment. It is pretty safe. Okay, when you have cash in the bank, the chances are you're never going to lose it, unless there's a fraudulent activity, scamming, obviously. But you know what? If you keep it under your mattress, chances are it's going to be relatively safe unless you get burgled. But the reason cash is a really bad investment is because over time, it loses its value. All right. And the way that I will explain this is, if you've got $100,000 in cash and you've got it in the bank account right now, the chances are, if you're lucky, you're probably going to get at most a 4% return. So after about a year, it's going to be worth about $104,000. Okay. But during the year, prices, as in inflation, will go up. And that erodes the value of your cash. So I know we've got clients who've got money and they're earning 1%, 2% interest, but then you look at how much they pay for their insurance, and their insurance bill's gone up 5%. So the growth in cash, it doesn't equate to the growth in what things cost. So generally, cash, most people will tend to say to you, cash is not a good investment as such. Then you get into something called bonds. Okay. Now, most people have heard of the word bonds, but most people have no idea what it means. And it leads me back to something that Warren Buffett said many, many years ago, which was basically the finance world tries to make things complicated so that people think it's an area that is complex and they need lots of help. The way that I'm going to explain bonds to you is, replace the word bonds with loans. Okay. And basically what you're doing is you're buying something called a bond, but basically it's a loan. Okay. So you're basically paying for something which is going to go somewhere else, and you're loaning someone some money. Okay. All right. So for example, let's take a bank. Okay. Bank will raise money every so often. And let's say, for example, they need $100 million. Well, the chances are they can't go to one company, one person, and say, hey, I want to borrow $100 million. Can you give me $100 million? Nobody has that kind of leverage around. So what they do is the bank comes out to the market and it says, you know what, everybody, guys, we need 100 million. And you'll get some people who will say, we'll pay you 5,000. We'll get some people who will say, we'll pay you 100,000. Some people will say, we'll pay 500,000. And by doing that, a whole bunch of people will give 100 million. And what the bank then does is they say, look, if you give us 100 million, we will pay you a guaranteed interest rate of whatever that rate's going to be. Okay, so let's say it's 5%. So if you put in $10,000, every year you will get $5,000, 5% back for that investment. Okay. The only other difference with bonds is it's actually tradable. So you can, even though you've given the bank a loan, the bank is going to give you a piece of paper that says you own X $1,000 or X number of bonds. Okay. And you can go to the market and sell those bonds or sell your loan to somebody else who's willing to buy it. Okay. A bit like shares. All right. Now, here's the thing. Because these bonds they come on the market fairly regularly. So you might have CBA, for example, who 4 years ago said, we'll give you 3%. And today they're going to come and say to you, you know what, we need some money. We're expecting interest rates to go down, so we'll only give you 2%. Okay. And what happens is your 3% one that was issued 2 or 3 years ago is more valuable now because people will want to buy the 3% one because at the moment 2% is what's being offered. And that's how bonds work, depending on what the current interest rate is and the interest rate the bank has decided to pay you way back. Now, there's two kinds of bonds. One is known as a corporate bond. So, for example, a corporate bond is when a company issues a bond. So someone like CBA might issue a bond and the money will go to CBA. You're basically lending money to CBA. Then you have what's called government bonds. And basically you are giving the government a loan, but it works exactly the same way. The difference is it's going to a government. And what happens with these corporate and government loans is, depending on how risky they are, determines what the interest rate's going to be. So, for example, if you were going to give money to CBA, you know that's pretty solid. That's quite a good bank. You know it's been there for many, many years. It's not going to default. Their interest rate's going to be a lot different than if I came to you as WOW Advisors and said, or MediSuccess and said, can I have, I want to borrow some money. Can you give me some bonds, please? And I might issue with some bonds, but you're saying, well, I don't really know how solid you are. You're probably not as solid as CBA. Your risk is a bit higher. My interest rate's going to be a bit higher. So that's how the corporate market works. The government market works in the same way. So, for example, the Australian the Australian government bond is going to be a lot stronger than, say, the South African bond. Okay, so that's how bonds work. Then we have the classic stocks and shares. Okay, so behind every stock and share is a company, is an entity that's trading. Okay, so again, something like let's take Apple, for example. Okay, so we buy shares in Apple. Okay. And Apple is a company, it's a trading entity. All right. Now, when you buy something like Apple, you are moving from possibly being a consumer to being an owner. Okay. So this is the way that I will say it to you, right? When you buy an Apple phone, you are expending money. You're a consumer. Okay. If you own some Apple shares, whenever somebody buys an Apple product, you're going to get something out of it because you now own a tiny little bit of Apple. Okay. So that's what the share market is. And the price of shares is purely determined by what the market believes is going to happen to that company. So if Apple's expectation is that their profits are going to, or cash flow is going to go up, the chances are the share price is going to go up. Okay. So the market and the pricing of shares is always determined by what the market believes is going to happen. Okay. Generally, shares are riskier than, say, bonds or cash. Okay. So we hear all about, every so often we get the big, huge headlines, right? The stock market's crashed. This has happened. That's happened. And that's what makes everyone really scared. And everyone starts thinking this is a dangerous place to be. Okay. The reality is that over time, the stock market and the share market tends to do quite well. So if you have read my book, The Passport to Financial Freedom, what you will find is that there's a graph in there and it shows you what's happened over the last 20 years. So if you had $1 in the year 1900 and you kept it in cash and you put it into a bank account, after 120 years, it will be worth about 242 bucks. And you know, and I know that you can't get an awful lot for 242 bucks. Okay. If you'd put that money roughly in Australian bonds, that would be worth about $1,000, 1,017 bucks. If you'd put the same amount of money in the Australian share market, it would be worth $481,910. Okay, so that gives you an idea of what shares are doing. Now, if you think about all the headlines that have happened of the share market collapsing in the last 120 years, you'd think it's a really risky place to be. We've had World War I, we've had World War II, we've had the Vietnam War, we've got all kinds of wars that have happened and banking crisis and all of that. And despite all of that, the share market has, over a period of time, gone up and has been significantly higher. Okay, now, without really knowing, you have already probably significant amount of your investments already in stocks and shares. And the reason is because if you have a superannuation fund, that fund has predominantly invested in the stock market. Okay, but you will have lots of other people who will invest outside the stock market in their own way, and then they will control that investment. Whereas when you invest in if you have a retail fund and it's in the stock market, the chances are the superannuation fund is determining what to buy, what to sell, and what to keep. Okay, number 4, real estate. Okay, so real estate is any property, whether that's commercial, residential, normally bricks and mortar. Okay, the downside of buying property generally is it's an expensive exercise. You have to pay stamp duty, you have to have a massive deposit. Very, very few people actually have the physical cash to pay for it outright, so it needs to be leveraged. Okay, a lot of people like property in Australia. In fact, Australia is absolutely fascinated by property. And one of the reasons a lot of people get into it is because they have this thing called negative gearing. Okay, now if you've read my blogs, you will know I do not like negative gearing. And from a tax perspective, it may give you an advantage. But I still believe negative gearing is a bad thing. And if you speak to various people who are in the wealth building regime or very influential people in that space, they will all tell you negative gearing is not a good thing. And the way that I'll explain negative gearing is it basically means you're making a loss on the property. Okay, so you're receiving rental income, for argument's sake, let's say that's $30,000. You're showing expenses which are more than $30,000. And if you do that, you create what's called a loss. And if you create a loss, then you can claim that loss in your income tax return and your tax bill goes down. And people love it. In fact, I have a lot of medical professionals as clients and they love this, okay? Because they see a tax bill go down and they think this is fantastic. However, from a cash perspective, money in your pocket perspective, it's not a good thing. And this is how I'll explain it. If you make a loss, so let's say you collected $30,000 from your tenant, you've paid out $40,000, okay, because you haven't paid the loan off, you've got interest, you've got rates, you've got all kinds of other costs. And let's say, for argument's sake, that comes to $40,000, you've got a $10,000 loss. Now that $10,000 loss is going to go in your tax return, and assuming you're a high rate taxpayer, you're going to get $4,500 back from the government. Okay, they're going to lower your tax bill by that. But let me remind you, you've actually paid out 10, you're getting 4.5 back, you're still 5.5 grand out of pocket. And that is why I don't like negative gearing. Okay, so negative gearing in my eyes bad. Necessary in the beginning, certainly, because when you buy property, you've got huge loans, my advice always is try and pay off the loan as soon as you can and get that into positively geared territory, because that means money in your pocket. Okay. There are a lot of people who will not have huge deposits and therefore cannot get into property investments. Okay, for those people, you would there are other vehicles you can use. You can buy something called REITs, which are basically like a bunch of, they're a bit like shares, but those shares are predominantly invested in property. You don't have to go out and get a massive deposit. You don't have to go and speak to any banks. You don't need to pay stamp duty. You don't need to do any of that. All you're doing is buying a bunch of shares, which all they do is invest in property or hold property. And that's one of the ways you can invest in property without having to deal with all the other rubbish that's around owning property and having to deal with tenants. Okay. Number 5, commodities. Not many people do this, but commodities is an investment asset. So you can buy things like agricultural products, coffee, oil, iron ore, all of those sort of things are commodities, and you're working on the basis that you're buying now, price of that commodity is going to go up, you then sell it at a later date and you make some money out of it. Okay, number 6 is what I called investment or alternative investments. Now here, you've got to be a bit careful. I've got my fingers burnt a number of times because I've jumped into this alternative investment market and I've got seriously burnt. Okay, so I have lost quite a bit of money in it. Be very, very careful if you are going to go into that space. Do your research. I've made some money and I've lost some money. I've decided now that it's not a place that I want to put my money in, but it might be for you. And this is where things like venture capitalists come aboard. You get buyouts, you'll get people who are putting money into crypto, that sort of thing. You know, a specific company it needs some seed capital. It needs, $40,000-$50,000. It's going to various investors to try and get it. It's quite risky, but if it works, it can be very, very lucrative as well. Okay. And the final one that I want to talk about is other businesses. And many of you will say, but hold on a second, I'm already spending 30, 40, 50, 60, 70 hours in this business. Why would I want to go out and buy another business when I probably don't have the time or the energy to do that? But having said that, we do have a number of clients who actually have bought other businesses on the basis of trying to use that or get passive income from it. And there are businesses out there that will allow you to do it. For example, we've got clients who have purchased gyms. Okay. And what they've done is, if you think about a gym is a 24-hour venue. And during the day, they've probably got one person at reception, a few hours in the morning, a few hours in the afternoon. But apart from that, the place generally will run by itself. You don't need an awful lot of time and effort into it. Okay. The other alternative business that you can use, and we have had clients in, is a childcare, where you've got specific people running that. So when I'm saying buying a business, I don't mean buy a business, then go in there and work. What I'm saying is you buy a business that is effectively already generating income and run on management. All right. So those are what I call asset classes. The chances are you're going to narrow this down and say, you know what, there are 2 or 3 things I like here. The rest I'm going to ignore. And that's what most people do. So if you were to do that, then there's nothing wrong with that. But just be aware of all these different types of investments, so that when you are having the discussion with your financial planner, at least you get an idea of what it is that they are talking about. I hope that was useful. Thank you for listening. Thank you for watching. Have a great day.